the setup is just so structurally bullish for Bitcoin coming into this next year. It's like, what, you're going to be in cash, and then what, Trump announces some version of the SBR in 7 days and you're caught on the sidelines. Like, you just can't risk being really in cash here on Bitcoin.
At 8:30, we got jobs data. Typically, big data releases come out at 8:30 in the morning Eastern time. And you can typically see what interest rates do because stocks are not open at 8:30. You can look at what futures do, but the indices themselves are not open. You can look at what Bitcoin does at 8:30. And it's actually kind of interesting because at 8:30, Bitcoin drops pretty quickly. And that was on the back of more jobs added in that data release than people expected. And this is one of these classic things, really ever since the financial crisis. It's this idea of good news for the economy. What looks like good news is bad news for asset prices, because the good news means the Fed isn't going to cut as much and therefore asset prices aren't going to pump as much. That's like the super oversimplified view here. But as the day has gone on, Bitcoin kind of, dropped pretty quickly at 8:30 in the morning, and then it like chopped around a little bit. It's low. And then later in the day, it started to rally again. But what's interesting is that stocks have stayed low that whole time. So what to make of this? It's a little speculative. We don't know what's causing Bitcoin to move in any given hour, but I would say the kind of two potential explanations are: one, there's a large buyer in the market that doesn't really care about what the jobs data said today, and they're just saying, hey, we're buying Bitcoin, so that's pushing the price up. Obviously, that would have to be someone buying in size. The other explanation could be if people are reading through the fact that inflation might be stickier than people think. But this kind of gets back to the whole macro thesis of the Fed and the government at large is caught between a rock and a hard place. And they're eventually going to have to just let inflation run somewhat hot to a certain extent. And if that happens, that's typically going to be good for Bitcoin and financial asset prices. So there's a ton we could dig into there, but that's kind of an opening macro summary.
It's so funny because we're in this moment where the economy is doing too well, so you need to sell all the equities. Like, come on, this is where this over-indexing to like the Fed reaction function is just wild. The market is now basically pricing no cuts or one cut for 2025. So when we started November or whatever, there were 7 cuts priced for 2025. We're now down to 1. And the S&P is down about 5% and Bitcoin's down a little bit. But what you can say there is the market has almost entirely priced out the cuts. Now, if you're me, what has to happen here in 10 days? Trump is coming into office. Scott Bessent is coming into the Treasury. You've got the 30-year bond at 5%. You've got the 10-year way too high. And you've got the dollar index at like 110. These are unworkable numbers for the incoming administration. So what do they need to do? They need to get the long end of the bond curve down. That 30-year needs to come down a lot. And the way they can do that is with the Fed. And so I think there's going to be an immediate political pressure to cut, to bring the long end of that curve down, or some other sort of intervention.
It's already started, Stephen. The political pressure has already started.
Like there's no conceivable way. So if the market is saying we don't see any cuts, I would say you should almost be certain there are more cuts than that coming. So it's honestly like not a bad foundation to be starting the year at. The yields and the cuts, those are political objectives. Like those can be managed politically. If the economy was falling off a cliff, that's a lot harder to manage politically. So I'd rather have, there's too many jobs and the economy's too hot, then, and we have to deal with yields and we have to deal with the dollar, then like the economy is crashing into a recession and yields are low. Like I honestly think, even though I think markets are panicking on this a little bit, it's a nice setup. And, to John's final point, and then you have Bitcoin rallying. Why is Bitcoin rallying? Well, A, maybe people understand that. And B, the setup is just so structurally bullish for Bitcoin coming into this next year. It's like, what, you're going to be in cash, and then what, Trump announces some version of the SBR in 7 days and you're caught on the sidelines. Like you just can't risk being really in cash here on Bitcoin.
And if you are a believer in the fiscal dominance, nothing stops this train thesis, part of that thesis is that 25, 50, even 75 basis point cuts or hikes on the other end by the Fed don't have as big of an impact as maybe they did historically. So I think that's also part of what you're kind of saying here, Stephen, is that, okay, if there's an extra cut in there, 25 basis points, that's not really what's driving markets right now. It might be in the short term because people are so used to that reaction function, but the environment we're in, it's not actually leading to that big of a change as people might expect it to.
100%. Let me just follow up there real quick. And also, like something Sean just said in the comments, is the market telling us the Fed is losing rate control ability? And to John's point and to Sean's, like, yeah, I think the Fed has kind of lost control of the bond curve, right? Because what I mean by that, let me explain that. So they've been cutting, like we've been in a cutting cycle. They have cut interest rates several times, and rates are basically higher than when it started. So the Fed has been ineffective at bringing these down. So there's two things that have broken. One, they've been ineffective at controlling rates. But two, bonds are down and stocks are down. People noticed in COVID that the relationship between bonds and equities completely broke, right? It used to be, if stocks were up, bonds were down. If stocks were down, bonds were up. There was like a hedging sort of component. And that was the 60-40 portfolio. And that was the Bridgewater, Ray Dalio, all-weather portfolio. And then in COVID, this pretty much like breaks down. And we're now here again, right? So, stocks have been doing fine 2023 and 2024, but this last kind of 3 or 4 week window, we're having bonds being sold off constantly. That's driving rates up. You're also having stocks falling. And so the normal environment is gone. It's like a uni market. It's just, there's only one market. It's either stocks are up or they're down, and there's nowhere else to hide. And this is breakage. This is something breaking.
Brandon, do you have any thoughts there?
Stay humble, stack sats.
Yeah. Ignore everything Steven just said. There's one thing you need to do. In fact, you can just stop watching the show, never watch it again, and just stack sats and stay humble. You'll be fine. This does make it.
Hold on, summary.
Yeah,
What I'm hearing is it's all vibes. So get with the vibes. And if the market is pricing in no rate hikes next year or rate declines next year, and we get some, then it's just going to overly pump because of that. And I think it's fair to assume that Trump wants that. Historically, he's always wanted to win, and he'll take the long-term pain in order to juice the economy. So,
yeah, I mean, he did say very clearly that he thinks the Fed needs to cut at his last press conference, which, we're back in a world of Trump press conferences, and they're always entertaining. that one was very interesting for lots of reasons. But he did say that. We do have a piece dropped this week by Lynn and Sam Callahan. She finally had Sam helped her kind of pull all of this together. She's been talking about nothing stops this train and fiscal dominance for a long time. And she put it into this piece, again, she and Sam. I think it's fantastic. Yeah, here we go. Full steam ahead, all aboard fiscal dominance. This is basically the cycle here. You have higher interest rates, higher interest expense goes to, and refinancing costs leads to larger fiscal deficits, which leads to more money printing like QE and direct monetization, which then leads to sustained inflationary pressure and then higher interest rates. And basically it's, the ability for the Fed to impact the economy with the tools it has, money printing and rate cuts primarily, and QE, et cetera, as she mentions here, different kind of money printing approaches, is not anymore the dominant way to affect the economy, right? They're losing their power because of fiscal dominance. Fiscal dominance is now driving Fed policy. And that's what she's talking about here. If you take a look at the debts, the public debt growth with fixed interest rate scenarios. So this is rates at 2, 3, 4, and 5%. Looking from 2024 to 2034, so 10 years out, we're looking at $45 trillion public debt growth. And that's proves the point here.
I mean, it's been a key topic, and it's one reason I think so many investors got the 2023 market wrong. I mean, this is kind of in the rear view window, and I see John nodding his head, but like if you were here for 2023, the Fed had just been like hiking rates, and you had a bad year in 22, but rates are staying high, inflation's still hot, so everyone's bearish and everyone's calling for a recession, and everyone thinks like these rates are going to crack everything. And then what happens is you have from mid 2023 to the end of 2024. I mean, was that like the best 1.5 year S&P performance of all time or something close to that, right? Like it just is a raging bull market while everyone's on the sidelines because of these high rates. And I think it broke people's brain. And I think it's a similar thing to this. Like, why was that? It's this fiscal story. It's the Fed is just not there.
I mean, it's interesting too. There's having some fiscal discipline is one way that you could work your way out of this, and it would take some time, obviously. But the problem here is that only 14% of the budget is actually discretionary. 87% is paying on interest, and mandatory programs like Social Security, military spending, etc. So it's the Congress really only has fiscal control over a small percentage of the federal government's budget. There's just not much it can do, and that's why nothing stops this train, right? So what are the implications then, John? I mean, if this is just the path that we're on and there's really no action to get away from it in the long term, there might be some short-term fixes here and there, but what does this mean in the long term for the United States and for the world?
Yeah, simple question. No, I mean, I think from an investment perspective, it means that there could be, nothing goes up in a straight line, of course, but generally speaking, financial assets are much more inclined. I'm talking US financial assets here to increase. Some people like the term melt up because it kind of highlights the fact that, okay, these asset prices are going up. It's not necessarily because someone invented some amazing new service, because their earnings are better. It's like increased liquidity because the system needs increased liquidity, and eventually it's going to get it. Again, you can have short periods of time where things don't look good because there's some idiosyncratic thing going on. You can have a year like 2022 where things turn around, but to go the other direction. But to Steven's point, look at what happened in 2023. There were so many people that were huge macro bears in 2023. I wouldn't put myself in the category of like being a huge bear in 2023, but I did not think it was going to be as good of a year for investable assets in 2023 as it was. Like I thought it was going to take longer to recover those 2021 highs. So that surprised me a ton. I have to admit that. Another example I would point to is March of 2023. Things can go wrong in the system. Things can break in the system, like the banking system. Silicon Valley Bank, First Republic Bank. But what people need to remember is that the Fed, the Treasury, the FDIC, they've become very good and fast at responding to these things. It's not 2008 where there's like months of Senate hearings where they debate, should we bail out this or not bail this out? Like it happens much more quickly now. So my base case is that there could be things that go wrong, but you have to ask yourself, is the incoming administration going to allow some situation where interest rates go to 6% on the 10-year on a sustained basis and the stock market is down 30% for months and months and months? Do you think Donald Trump is going to allow that? That should not be your base case. If I were going to try to play the other side of it, the only situation I could see is where it actually happens. Rates go crazy and the stocks are down for a prolonged period of time, is like some insane geopolitical event that like we can't even predict what it is. But even then, it's like you probably get more liquidity on the back of it. The other way would be like if there's truly forces within the government that are trying to stop Trump and all his appointees from actually accomplishing things. And I know I'm being vague there because I'm just trying to play the other side of it. But again, my base case is that the new administration and all of his appointees are very, very inclined to see positive financial asset performance as soon as they take office.
Yeah, 100%. 100%. Like there's just no, and it's like it's asset performance, and it's also the fundamental functioning of the treasury system, right? Like it's even more like Scott Besson is not going to come on and be like, yeah, I guess like bonds are just going to get relentlessly sold off for the next year nonstop and no one's going to buy them. Like bullshit.
I mean, another piece of the puzzle here is demand for US dollars. I know you posted about the DXY earlier this morning, Stephen, about how it's just sky high right now.
Yeah, let me see where it's at right.
So there's
Yeah.
there's going to continue to be persistent demand for dollars and debt based in dollars, and so fiscal dominance will continue, right? Because of that, right? The dollar is going to continue going up and become more powerful. Therefore, fiscal dominance. It's hard in that environment. It's hard for fiscal dominance to go away or be lessened. So there's just a lot of factors pointing to nothing stops this train, and it's the world we're in.
DXY, the dollar index, is basically just shy of 110 right now. I mean, these are huge problem levels, not just for the US, but for other countries, for their debt levels, for what it costs to service their debt. Everything needs to come down from here. When I say everything, I mean yields, and I mean the dollar index, or things start to break.
There's one point related to this that I'd like to make, and I think Luke Groman is the one who said this. I've consumed so much content, sometimes it's hard for me to remember where I heard it. I think it was Luke. You need to distinguish between increasing dollar usage across the globe versus the value of the dollar measured by DXY going up.
Totally.
Like, you need to remember those are two different things. And generally speaking, Trump, really any administration on either side, Treasury Secretary, they want dollar usage to increase for sure across the globe. Like, they want the dollar to be entrenched in terms of usage. They don't necessarily want the Dixie to go through the roof. And if you look at what the Dixie did during Trump's administration the first time, it pretty quickly got weakened when his administration got in. People have been overlaying those charts and kind of implying like, hey guys, this is likely to happen again. So just always remember to distinguish those two things about the dollar.
Dude, there would be a great, like, if you had a similar show to ours, but it was for women and it was about traditional finance, you could call it the Dixie Chicks. That'd be really that'd be fire.
I mean, we could be the Dixie Dudes.
Marianne and Wanda were the best of friends all through their high school days. Isn't that an argument for the stablecoins, essentially? Like, proliferate dollars everywhere and buy treasuries on the back end?
Yeah, it is. It is. That's honestly true. Like, you need, like, there's not enough buyers on these treasuries right now. If there were more buyers, those rates would come down. That's just how the market works. Like, people are selling treasuries and someone needs to start buying them.